Hello, and welcome to our next NAP. NAP stands for Nonprofit Auditor Points, and I'm Irina Oishkova, your nonprofit auditor. Happy to be here today. I am planning to talk to you about how we as auditors test any debt, long-term debt, specifically typical loans that the organization have. Hopefully you will find this information useful in order to make sure that your nonprofit treat any debt correctly, records debt on financial statements correctly, and maintain all necessary records available for audit purposes and overall record keeping. Let's start. A lot of nonprofits have some sort of long-term debt. Small nonprofits very often have mortgage. Sometimes nonprofits have related party debt, taking loans either from board members or other parties that they know, or other nonprofit organizations, and or they just simply have line of credit from the financial institutions. And it's very critical to record debt correctly. So where we as auditors start? If we see that the organization has a debt, we're asking for the loan agreement. And if it's a conventional loan agreement is always present. All financial institutions always give it a loan agreement. However, we see that very often if the loan is from a related party, the loan agreement might be missed, not present. We highly encourage nonprofits, regardless who is your lender, especially if it's related party, loan has to be properly agreed on, meaning that every loan agreement has to have date when it started, maturity date, payments, some sort of payment schedule, when the payment is due, and interest rate, and who is the party to the loan. So, and that's at the minimum. And we as an auditors look at all the information, including collateral. That information is very critical for several reasons. So first of all, under general accepted accounting principles, every transaction, even if it's between a related party, should be treated as non-related, objectively. Meaning all loans will have some interest rate, reasonable interest rate. We're looking for collateral. If there is a collateral, then that information needs to be presented in the footnotes to financial statements. We're looking at maturity date. Some loans can be paid gradually through useful life of the loan, the period of the loan. Some loans have balloon payment at the end, maybe in the middle, and interest rate needs to be disclosed. Also, if it's applicable, a lot of lenders have amortization schedule that indicates when the payment is due and how much payment is due. And that amortization schedule is very useful not only for the auditors, but also for the organization, because you need to know every time you're making payment, how much that payment includes principal and interest. Because principal will be recorded as a reduction of the loan on a balance sheet, and interest expense is just an expense in a profit and loss statement. So that schedule every bookkeeper should have, and every time when bookkeeper pays the invoice for the loan, each payment needs to be split between principal and interest, and make sure that at least at the end of the year, the principal amount per amortization schedule agrees to the principal amount that it's recorded on a balance sheet. This way, bookkeepers will confirm that they properly record the payment of the loan. Sometimes we do see that nonprofits they change their amortization schedule because they change an agreement. They might either expand the loan, get additional loan, or they skip a payment or accelerate the payment. And that requires modification and amortization expense schedule. If that happens, please make sure that you get new amortization schedule. I think any lender will provide it to you. If for whatever reason you do not have updated amortization schedule, you can prepare your own schedule, because you still again need to have it in order to properly record every payment on the loan. It's also very useful for the nonprofit to make sure that they understand if there's any restrictions on the loan or any collateral on the loan. Some lenders put the building as a collateral. Some lenders can actually say your accounts receivable or other collateral. If there's such collateral exists, it absolutely needs to be presented on financial statements, and it might affect the organization overall liquidity. Some lenders will require nonprofits to put some reserve cash in a separate account until the loan matures, and if that happens, that cash money in specific account needs to be treated as restricted and cannot be touched based in accordance with the loan agreement. So there definitely nonprofit needs to understand all the limitation and requirements of the loan. Also, at the end of the year, we do ask to provide us the last statement from the lender that indicates the outstanding amount of the loan. So we're not simply relying on amortization schedule. We want to obtain the confirmation from the lender that the payments were made in accordance with the schedule. And also very critically to remember for nonprofits, if the loan has been refinanced, restructured, accelerated payments or deferred payments, every time new amortization schedule needs to be prepared, and the organization needs to maintain all the documentation from initial origination of the loan until the loan exists, because that information will be very critical. We in our audit world call it PERM documents, meaning permanent documents, and they need to be preserved until the organization has a loan. If very often, if we test the debt and the organization, for whatever reason, because it's related party, its board member does not have a loan agreement, it needs to be treated from the accounting standpoint as a short term, meaning it can be payable on demand, meaning that the lender at any moment can demand the payment in full. And that might affect the presentation on the balance sheet, and overall that gonna appear that organization has a lot of current debt, might affect liquidity and overall presentation, non-favorable presentation. Again, from the legal standpoint, I'm not an attorney, I'm not advised, but in order to protect yourself, the organization absolutely have to have some writing for every debt and agreement that the organization is involved in order to protect nonprofit, right? So it's due care of every executive director and board. Make sure that the agreement is actually written, that both parties understand what is the outstanding debt and what is the payment on that debt. So the lender cannot just appear and say, pay to me amount in full, because you can put the nonprofit in a very sensitive position that a nonprofit might not be able to make a payment, or if the nonprofit makes a payment, it's going to put nonprofit in very challenging liquidable position. It will not continue to operate. Some lenders do have ability to forgive the loan if from after some period of time, but the organization need to make sure that it's obeyed to the terms of the loan. If the forgiveness is possibility, that also information will be disclosed on financial statements. So again, that for us as auditors, we need to understand that was a loan, and as long as it's a loan, it's still going to be capped as a liability. At some point, when the loan is forgiven, it will be recorded as a contribution and will be moved from liability to the revenue. Just to summarize, loans are agreement between two parties, the nonprofit and the lender. And it's always advisable, regardless who your lender is, that needs to be documented. With the conventional lenders, there's always going to be loan agreement, amortization, and monthly schedules, monthly invoices. However, very often such information might be very challenging to obtain if the loans come from related parties or small individual lenders. That's for the benefit of the nonprofit. Make sure that regardless who's your lender, you do have amortization schedule, you have loan agreement, and you ask from the statement from the lender on a monthly basis. It's very critical to make sure that both parties have the same understanding of the debt, and the debt does not put nonprofit in a vulnerable position. Thank you so much. Thank you for being here with me. Looking forward to see you for the next snap. Be safe.